So, if you've been seeing the headlines about home prices falling in places like Princeton, Texas, you're probably asking yourself a big question. Is it time to run for the hills, or is this a huge opportunity? Well, today we're going to cut through all that noise and turn that confusing data into a clear, actionable investment playbook.
So let's just get right to the heart of it. This is really the only question that matters for an investor looking at a market like this one. When you see prices dropping, is that a giant red flag telling you to stay away? Or is this the moment you've been waiting for?
And you know what? The data gives us a pretty clear answer right off the bat. The market isn't crashing, it's rebalancing. And what's so fascinating is that all that leverage, all that negotiating power, it's shifting, and it's shifting big time, away from the sellers and right into the hands of smart buyers who know what they're doing.
So here's how we're going to break it all down today. First, we'll decode what the market data is really telling us. Then, we'll build out a specific negotiation playbook. After that, we'll get real about the rental market, face some tough numbers on cash flow and risks, and then we'll pull it all together into a final action plan.
All right, let's roll up our sleeves and dig into the data. What are the specific signals out there that are just screaming that this is a moment of opportunity for buyers?
Well, first up, the big one, the one that gets all the headlines. We're seeing a really significant 10 to 15% drop in median prices compared to this time last year. That's not just a little dip, folks. That's a real market correction.
Next up, look at how long it's taking to actually sell a home. We're talking an average of 40, even 50+ days on the market. And you know what that means? The longer a house just sits there, the more motivated that seller gets. That's a huge psychological shift in the market.
And all that time on the market. Well, that leads us right to inventory. Right now, there's about a 4-month supply of homes for sale. That's a pretty healthy amount. And it makes you ask the question, where are all of these houses coming from all of a sudden?
And this is where it gets really, really interesting. Check this out. The inventory is split almost perfectly down the middle. Half new construction, half resales. Now, why is that so important? Because those big home builders, they are effectively setting the price ceiling for the entire market. They have to move their product, and that puts a ton of downward pressure on everybody else's prices.
So, what does this all mean for you, the investor? It means you can forget about those insane bidding wars from a couple years ago. They are gone. What's replaced them is good old-fashioned negotiation. And right now, homes are consistently selling for 2 to 3% below what the seller is even asking for.
Okay, so we understand the battlefield now. We get what the market looks like. So let's build our playbook. Because the key here is that you can't use the same strategy for every seller. You've got to tailor your offer.
This lays out the 2 different paths you can take. On one side, you've got the builders. For spec homes that have been sitting a while, they hate slashing the list price. It messes up their numbers for future sales. So the real win here is to push for incentives. Ask for them to buy down your interest rate or cover all your closing costs. Now, flip that coin over to resales. It's a totally different ballgame. For a house that's been on the market for a month, you can get right to the point. Start your offers at maybe 94 to 96% of their asking price. And, this is critical, never, ever waive your inspection contingency.
So, want to know where the most motivated sellers are hiding? This chart is basically a treasure map. You see that the fastest sales are happening in that sweet spot between $260,000 and $330,000. But look at the high end. Homes over $380,000 are sitting for the longest time. That's where your biggest negotiation opportunities are waiting.
Okay, so let's say you did it. You used the playbook, you locked in a fantastic deal. That's awesome. But what happens now? What does the other half of the equation, the income side, actually look like? Let's get into the rental reality on the ground.
Here's the number you need to just lock into your brain. For a pretty standard 3 or 4 bedroom house in the area, you should expect a median rent of right around $2,000 a month. The demand is there and the market is pretty stable.
So who are you actually renting to? Who is your customer? Well, the data paints a really clear picture. Your typical tenant is probably commuting to the job hubs in McKinney and Plano. They're often working in tech or logistics. They're pulling in good money, usually 3 times the rent, and they have solid credit, typically 620 or higher.
And just like buying a house, timing is everything when it comes to renting it out. The market absolutely peaks between April and August. That's when demand is highest. But once you get into the slower winter months, say November to January, you might have to sweeten the pot a little. Maybe offer a small incentive to get someone in the door quickly and keep those vacancy days to a minimum.
Now, we spend a lot of time talking about the opportunity, which is great, but a truly smart investor always stares the challenges and risks right in the face. So let's pivot and talk about the crucial numbers and the very real risks you have to be ready for.
And look, there's no way to sugarcoat this. We have to talk about the huge elephant in the room for any real estate investor right now, and that is the high cost of borrowing money. And yeah, there it is. In a conservative scenario, you could be looking at some serious negative cash flow every single month. I know, that number is a gut punch. But before you panic, it is absolutely essential to understand why it looks like this.
So let's just break down the math. When you factor in an interest rate around 6.75% on top of property taxes, insurance, and everything else, that $1,900 in rent just doesn't cover it, not even close. So this is the moment you have to be really honest with yourself. This is not a cash flow play today. This is a long-term appreciation play, where you're buying the asset at a discount and you're prepared to cover that monthly shortfall for a while.
And beyond the cash flow, you've got to watch out for some local landmines. You have to double-check the property taxes. They're higher for investors. You've got to sniff out any of those special MUD or PID district costs. And you've got to triple-check that the HOA even allows rentals. And, hey, it's Texas. A top-to-bottom inspection of that foundation and roof is completely non-negotiable.
All right, we've seen the data, we built the strategy, we understand the income, and we faced the risks. So now let's put it all together. Let's boil it all down into your final, concrete action plan.
It really comes down to these 3 simple steps. 1. Define your buy box. Know exactly what you're looking for. Newer 3 or 4 bedroom homes under $320,000. 2. Master your due diligence. Become an absolute expert on the local taxes, the HOA rules, and the physical shape of the property. And 3. Tailor your strategy. Know exactly how to approach a builder versus how to approach a regular resale.
And that leaves us with one final thought. When you look at all the data, the picture becomes crystal clear. Princeton is not a market for a house flipper trying to make a quick buck. This is a market that rewards patience, that rewards a careful strategy, and rewards having a long-term perspective. So the only real question left to ask is, are you ready to play the long game?